Welcome back, friends, to another video. Funny story. There is a video that I have never uploaded to YouTube. So we have to go back 8 months ago. And 8 months ago it was March, and I was doing a 6-part video series on capital assets. And just before I was going to post the final installment of that video series, the pandemic hit the United States. The president declared a national emergency and the stock market crashed. And so instead of posting that video, I instead posted a video on the stock market crash and what was going on in financial markets around the world. And every week since then, I keep pushing back uploading this video because there's something else big going on in financial markets that I wanted to talk to you guys about that week. Well, here we are, 8 months later, and I still have not posted this video, and I can't wait any longer. So this week, I'm going to post the final installment on my 6-part video series on capital assets. If you want to watch the full series, I'm going to post the link to the playlist in the description box down below. The funny thing about this is you're going to see me from 8 months ago. This is me before the pandemic, before all of the stress over the financial market collapse. I don't know if anyone can relate to this, but I feel like I've aged over the last 8 months. Also, before we get into the video, I want to do a quick announcement. This week, I'm going to be doing a live Excel training class. We're going to do a live stream right here on this channel. It's going to be this Thursday at 10 a.m. Phoenix time. It's going to be free and it's going to be live, so you'll have a chance to ask me questions while we're going through this Excel training. I am really excited about this, so I hope that you are too. We are going to be talking about how to set up your Excel worksheets, and I'm going to be giving you a lot of tips that I don't see a lot of people do that could really be helping you as you work with Excel. So if you miss it, don't worry, I will be uploading the stream after the fact so you can watch it then, but keep your eyes open because it will be happening this Thursday. So I hope you are ready. Here's this week's video. Welcome back, friends, to another weekly video. We've been talking a lot lately about capital assets and depreciation, and so in this video I wanted to focus on the question why. Why do we do depreciation? You know, it is a lot of work, it's very complicated. Why do we do it? Well, the reason why is because of stock investors. So in this video, I'm going to be talking about owners of companies and stock investors and how they think about depreciation. As accountants, our primary responsibility is to deliver a set of financial statements. And the people who read these financial statements are going to be owners of companies, stockholders, debt holders, and other stakeholders in your organization. Now, when these people read your financial statements, they're primarily trying to answer one central key question. Does this business model still work? Every organization is a business model. There is money going in and money going out. For a business, you want this business model to generate a profit. For a nonprofit organization, you want to make sure your organization remains solvent. So we've talked before about how capital assets are a strategic purchase. These are big purchases your business makes in an area of competitive advantage to enable business operations. So what stock investors are doing is they look at depreciation to determine if the business model is still profitable. So you can't just look at the cash flow from operations, you have to look at operations plus the impact from capital assets. Let's use the example from last week. You bought equipment for $100,000 that you're going to use for 5 years. If you use straight line depreciation, you would use $20,000 of that investment each year for the next 5 years. This capital investment will allow your business to generate sales. So let's do a sample income statement each year. Assume $40,000 in sales, $20,000 in cost of goods sold for a gross profit of $20,000 each year. Well, this analysis is incomplete unless you also include the impact from depreciation, which is another $20,000 expense each year. Your real profit is $0. This is telling stock investors that this business model does not work. Without depreciation, you would be getting misleading information. It is also important to realize that depreciation affects both the balance sheet and the income statement. There are two things going on. You are reducing the value of the assets recorded on the balance sheet, and at the same time, you are recording the expense on the income statement. This takes the form of a journal entry of debit to depreciation expense, which is an income statement account, and a credit to accumulated depreciation, which is a balance sheet account. So every year you are showing how assets are decreasing in value as you use them. Decreasing the asset on the balance sheet shows investors how much assets they really have left. This is really important because if they want to keep the business model going out into the future, they're going to have to invest in more capital assets when the equipment in place becomes worn out. These examples are all very simplistic. And you have to realize in an actual business, things get so much more complex. You're going to have hundreds, if not thousands of capital assets, all with different lifespans. And the only way an owner or a stock investor is going to be able to make sense of all of this complexity is for them to look at depreciation expense. This is going to allow them to answer that question: does this business model still work? I'm Zach from Wolves in Finance. Thank you so much for watching. Let's go out and make some money.